Hello everyone. Welcome to my Workbook Solutions videos for Managerial Accounting. This video covers Chapter 23, Differential Analysis. Please note that if you are watching this video at a much later date than it was posted, the chapter number may have changed as well as the page number of each example in your workbook. Overall, that shouldn't matter as the example problems we'll work through will still help explain the material. I'll also show the question in its entirety within the presentation, so you won't actually need a physical copy of the workbook, though having one will make the process much easier for you. Without further ado, let us proceed. Let's start on the first page. You have been offered two different jobs for the upcoming summer. Since both are full-time positions, you must choose to work only one of the jobs. The first job is in an office. The pay will be $320 per week. The office is located 20 miles from your home, so you estimate that you will spend $25 per week on gas. You will also have to pay $25 per week for parking. Because you are required to dress professionally, you will need to purchase some new clothes. You estimate that you will spend $350 on new clothes for this job during the summer. The second job is at an amusement park. The pay will be $220 per week. The amusement park is also 20 miles from your home, but you can carpool with a friend. Your share of the gas will be $12.50 per week. There is no charge for parking. The amusement park will furnish you with a uniform, so you won't need to buy any special clothes. Assuming that your summer break will allow you to work 12 weeks, which job will provide you with more money? We will compare the relevant revenues and expenses for both of these job opportunities, starting with their pay. Each job will last for 12 weeks. The office job pays $320 a week, and the amusement park pays $220 a week. Multiply the number of weeks by their weekly compensation, and you'll see that the office job pays $3,840 for the summer, while the amusement park pays $2,640. Taking the amusement park position nets $1,200 less than the office job. Going by raw income, the office job is the better position. But the office job also has expenses that the amusement park doesn't. The question becomes, will the office job's higher pay more than offset its associated expenses? Starting with fuel. The office job necessitates spending $25 a week on gas, but since you can carpool with a friend, the amusement park's cost of commuting is only half that. Multiply those weekly costs by 12 weeks, and the office job requires $300 in gas, while the amusement park only requires $150 in gas, meaning that choosing the amusement park would yield $150 in fuel cost savings. Next, there's parking. The office requires you to pay $25 a week for a parking pass, but the amusement park has free parking. Multiply that $25 a week by 12 weeks, and you're paying an additional $300 to work at that office. Opting for the amusement park would therefore provide $300 of additional savings to mitigate its lower pay. Finally, there's the issue of work clothes. The office job has a professional dress code, which means you'll have to spend $350 on workplace attire. But the amusement park will furnish you a uniform at no cost. So that's that much more cost savings you'll get by choosing the amusement park. Sum up those columns, and the office job's pay nets to $2,890, while the amusement park only nets to $2,490. Even with its cost savings, choosing the amusement park would still pay you less by $400, so you're financially better off by taking the office job. Turn to page 3 to see the following example of Gooding Foods, which makes Goody Good brand peanut butter. The cost to make each jar is $2.05 and consists of the following per jar costs: direct materials of $1, direct labor of 25 cents, variable factory overhead of 30 cents, and fixed factory overhead of 50 cents. A grocery store chain wants to purchase a generic brand peanut butter from Gooding and is willing to pay $1.50 per jar. The generic peanut butter will be made using a different recipe, lowering direct materials costs to 80 cents per jar. Gooding can produce this special order using excess capacity, therefore fixed costs will not increase. Use differential analysis to determine whether Gooding should accept this special order. Our options are either to reject or accept this special order. Just by comparing the raw total costs, the standard cost to make each jar is $2.05, and the grocery chain is offering us $1.50 a jar. So right off the bat, we're inclined to reject the offer. However, if we examine the differences between relevant revenues and relevant expenses, that may not be the case. Starting with differential revenue, if we reject the offer, we get nothing. But accepting the offer provides incremental revenue of $1.50 per jar. Standard direct materials per jar is $1, but the recipe for the generic peanut butter would lower this cost to 80 cents. Rejecting this offer would provide no additional expenses, but accepting it would increase this expense by that 80 cents per jar. The per unit direct labor cost would not change with this order, so rejection would result in no increase in labor costs, while accepting it would increase this cost by 25 cents per unit. Likewise, variable factory overhead would still be 30 cents per jar, so that would be the differential increase in this cost. Fixed overhead is 50 cents a jar, but fixed overhead would not increase if this order is accepted, so it can be ignored within this analysis. Net income per jar will be nothing if we accept this order, but 15 cents per jar if we accept it, which is also the differential increase. Since income will increase if we accept this order, that is what we should do. Turn over to page 3. Grayson Enterprises currently manufactures part A14, one of the component parts used to assemble the company's main product. Specialty Parts has offered to make part A14 for $12.50 per unit. Grayson's per unit cost to make part A14 is $14.75 as follows. Each part uses direct materials of $5 per unit, direct labor of $6 per unit, variable factory overhead of $1.75 per unit, and fixed factory overhead of $2 per unit. None of Grayson's fixed overhead costs will be eliminated if the part is purchased. However, the plant space currently used to manufacture the part can be leased to another company for $30,000 per year. Assuming that Grayson needs 100,000 parts per year, should the company continue to make Part A14 or buy it. In this problem, we consider a make or buy scenario. Note that none of Grayson's fixed overhead costs will be eliminated from purchasing this unit, so we can exclude that item from the analysis. Direct materials, direct labor, and variable overhead, however, will be impacted. There's also a purchase price that will differ between choices. Specifically, $12.50 per unit. Finally, Grayson can earn some lease revenue from the purchase option. $30,000 a year from leasing out the unused plant space if we buy the part. This $30,000 is given on an annual basis, but all the other relevant costs we identified are on a per unit basis. So to make a comparison between these two choices, we need to convert the per unit amounts to totals for the year. Starting with direct materials. If we manufacture this part in-house, we're going to incur a cost of $5 per unit made. Combine that cost with the 100,000 parts to be manufactured during the year. Multiply $5 times 100,000, and the total materials cost will be $500,000. Do the same for direct labor per unit. Multiply $6 per unit by 100,000 units to get $600,000. Variable factory overhead, $175,000. If we buy the part, none of those materials, labor, or variable overhead costs will be incurred, but we will have to pay $12.50 per unit times the 100,000 units purchased, or $1,250,000. Now we can figure out the impact on net income between these two scenarios. Making the part will cost $1,275,000, while buying the part will only cost $1,220,000, resulting in a net cost savings of $55,000. So Grayson should buy the part. We can also analyze this decision on a per unit basis. Again, just focusing on relevant costs. Direct materials, direct labor, and variable overhead are already given on a per unit basis. Likewise, we know the price per unit if we purchase the part externally. The incidental lease revenue from buying the part is $30,000 a year, but we can divide that total by the 100,000 parts purchased to get revenue effectively generated per part, 30 cents per unit. Consequently, the total relevant cost per unit of making this part is actually $12.75. The net per unit cost of purchasing this unit after offsetting its price by the new revenue stream is actually $12.20 per unit, providing a per unit cost savings of 55 cents from outsourcing this parts manufacture. so we should buy the part. Turn to page 4 and let's look at a furniture maker. Modern Company manufactures wood desks. It has the opportunity to buy handles for the desks at $8 per unit. This purchase would affect costs as follows. Here in the table, you see the impact this scenario would have on the unit selling price, monthly sales volume, unit variable cost, purchase price for the handles, and fixed costs. Decide whether the part should be made or purchased. This problem is the same type as the previous one, so if you feel so inclined, perhaps pause this video and try this one on your own. Before we begin our comparison, note that the following revenues and costs are given on a per unit basis. However, fixed costs are given in the aggregate. Since fixed costs will be impacted by this decision, they need to be incorporated into the analysis, but we can't compare them to per unit figures, meaning we'll need to convert our per unit amounts into aggregate amounts. Starting off with sales price. Neither the per unit sales price nor the sales volume will change depending on whether we purchase these handles, so we can ignore these items entirely. Unit variable costs will change though. For each scenario, multiply the monthly sales volume by the unit variable cost. 500 times $95 for make, and 500 times $88 for buy. These calculations simplify to $47,500 if we make the handle, and $44,000 if we buy it. The differential effect if we outsource its manufacture is $3,500 in cost savings. For the purchase price, multiply the sales volume by the handle purchase price. 500 times 0, or 0 for make, and 500 times $8, or $4,000 for buy. If we purchase the handles, the differential effect from this item will be $4,000 more in costs. Fixed costs are already in their aggregate amounts, so put $5,500 under make and $4,700 under buy. Buying the handles will yield $800 in cost savings. The total cost for each scenario. If we make the handle, we'll spend $53,000 doing so, and if we buy the handles, we'll spend $52,700 for the convenience, meaning buying them will provide a net savings of $300, so we should outsource their production. You could have come to the same conclusion if instead of converting the per unit cost into totals, you converted the fixed costs into per unit amounts. The unit variable costs and the purchase price would be listed as shown. The differential effect on a per unit basis would be $7 in cost savings for variable costs and $8 in additional costs for the purchase price. To convert fixed costs to a per unit basis, divide those total amounts by 500 units. The per unit fixed cost is $11 for the make option and $9.40 for the buy option, meaning we will save $1.60 in fixed costs per unit from buying the handles. total costs come to $106 per unit under make and $105.40 under buy. So we'd save a total of 60 cents per unit from buying the handles, making that the better option, if only marginally so. You can verify that the math makes sense because if we multiply that 60 cents by the 500 unit sales volume, we get total cost savings of $300. The very amount we determined using aggregate figures. Apple Valley Orchard sells apples for $15 per bushel. The company has considered processing some of its apples into apple butter. Each bushel of apples will yield 2 dozen jars of apple butter, which can be sold for $1.50 per jar. The additional cost to process the apples into apple butter is 75 cents per jar. Use differential analysis to determine whether Apple Valley Orchard should make the apple butter. The sales revenue for selling a bushel of apples is $15. So how much revenue would be earned from converting that bushel of apples into apple butter and selling that instead? One bushel of apples will convert into 24 jars of apple butter, which can be sold for $1.50 apiece. So the revenue garnered from converting a bushel of apples into apple butter is $36. The differential effect from selling apple butter as opposed to apples is $21. Making the apple butter, however, will necessitate some additional costs, specifically an additional 75 cents per jar produced, so $18. Of course, if the apple butter is not made, there are no additional costs. The net income from selling apples is therefore $15, and $18 from selling apple butter, meaning processing the apples into apple butter would yield an additional $3 per bushel. So Apple Valley Orchards should make the apple butter. Turn to page 7 to consider a lease or sell decision. RCC Construction is considering selling excess machinery with a book value of $125,000. The original cost of $340,000 less the accumulated depreciation of $215,000 for $102,000 less a 5% brokerage commission. Alternatively, the machinery can be leased to another company for a total of $125,000 for 5 years, after which it is expected to have no residual value. During the period of the lease, RCC's cost of repairs, insurance, and property tax expenses are expected to be $36,500. Prepare a differential analysis to determine whether RCC should lease the machine, alternative 1, or sell the machine, alternative 2. The first item of consideration is the book value of $125,000. The amount consists of the original cost minus the accumulated depreciation to date. These costs were incurred in the past, so they are sunk, meaning they are completely irrelevant to this decision. The sales price of $102,000 less the brokerage commission is, however, pertinent. If RCC sells this piece of equipment, it'll earn $102,000 in revenue, but it'll incur a cost of selling of 5% of that amount, or $5,100. Yielding a net profit of $96,900. If it chooses to keep and lease the equipment, it'll earn $125,000 in revenues. While incurring maintenance costs of $36,500, providing a profit of $88,500. In other words, selling the equipment will provide $23,000 less in revenues than leasing it, but $34,100 less in costs, so selling it will provide $8,400 in profit over the alternative, so RCC should sell it. Turn one page to the right to page 8 to consider a lease or buy decision. Pompano Corporation is considering new equipment. The equipment can be purchased from an overseas supplier for $95,000. The freight and installation costs for the equipment are $4,500. If purchased, annual repairs and maintenance costs are estimated to be $3,600 per year over the 4-year useful life of the equipment. Alternatively, Pompano can lease the equipment from a domestic supplier for $29,200 per year for 4 years with no additional costs. Prepare a differential analysis to determine whether Pompano should lease alternative 1 or buy alternative 2 the new equipment. If Pompano Corp buys the machine, it'll pay a $95,000 purchase price. Additionally, it'll pay freight and installation costs of $4,500 as a result of the purchase. The new machine will require annual repairs and maintenance costs of $3,600 a year for 4 years, or $14,400. If Pompano instead opts to lease the machine for $29,200 a year for 4 years, it'll pay a total of $116,800 over that period. The total cost of leasing the machine is therefore $116,800, whereas the total cost of purchasing the machine is $113,900, meaning buying the machine is $2,900 less costly, so that is the better option. I promise the answer will not always be alternative 2. That's just the way I happen to structure these solutions. Turn to page 9 for a new type of problem. The condensed product line income statement for Dish It Out Incorporated for the month of May is as follows. Here you see the sales and associated expenses for 3 product lines: bowls, plates, and mugs. Note that mugs are generating a $5,600 loss, meaning that perhaps it should be discontinued. Fixed costs are 15% of cost of goods sold and 25% of selling and administrative expenses. Dish It Out presumes that fixed costs would not be materially affected if the mugs line were discontinued. Prepare a differential analysis as of May 31st to determine whether to continue alternative 1 or discontinue alternative 2 manufacturing mugs. The question becomes, do we keep or get rid of the mug product line due to its generating a loss? To determine that answer, we look at how sales and expenses will change between those two options. Starting with revenues, if we keep the product line, Dish It Out will keep that $43,500 in revenues, but discontinuing the product line will lower those revenues to 0. As for cost of goods sold, keeping the mugs will keep that expense of $26,700. How much of CGS will remain if mugs are discontinued? 15% of that amount is fixed, meaning $4,005 of cost of goods sold will still be present even if the mugs product line is not. In other words, getting rid of mugs would eliminate $22,695 of cost of goods sold. Selling and administrative expenses will still be $22,400 if the mugs are kept, but only 25% of that cost will be incurred if they are discontinued, or $5,600, meaning $16,800 of selling and admin expenses would be eliminated. The loss if Dish It Out keeps manufacturing mugs is $5,600, the loss shown in the income statement above. However, that loss increases to $9,605 if mugs are discontinued, resulting in an additional loss of $4,005. Even if mugs are generating a loss, they generate enough revenue to offset at least some of the company's fixed costs, so they should be kept in production. Turn one page to the right to look at Covalite Computer Company, which has been purchasing carrying cases for its portable computers at a purchase price of $89 per unit. The company, which is currently operating below full capacity, charges factory overhead to production at the rate of 40% of direct labor costs. The total unit cost to produce comparable carrying cases are to be as follows. Direct materials, $53. Direct labor, $26. Factory overhead, which is 40% of direct labor, $10.40. And the total cost per unit sums to $89.40. If Covalite Computer Company manufactures the carrying cases, fixed factory overhead costs will not increase, and variable factory overhead costs associated with the cases are expected to be 15% of the direct labor costs. Prepare a differential analysis dated as of February 24th to determine whether the company should make alternative 1 or buy alternative 2 as carrying cases. Here we have a make or buy decision, not unlike the ones we've already covered. If you like, perhaps pause the video here and see if you can determine which option Covalite should choose and what the differential cost would be. Upon first observation, the $89 purchase price is 40 cents less than the total manufacturing cost per unit, but that fact doesn't automatically mean purchasing is the better option. Specifically, we need to adjust the factory overhead amount of $10.40. Note that variable overhead is estimated to be 15% of direct labor costs. So of this $10.40, only $3.90 is variable overhead. Fixed overhead is the remaining 85% of $26, or $22.10. Since fixed overhead will not change between these two choices, we can omit this cost from our analysis. The relevant overhead amount for this problem is the variable portion of $3.90, making the total actual cost of production $82.90. If the case is bought, instead, these costs will not be incurred, providing cost savings for their respective amounts. If Covalite purchases the cases, it will pay $89 per case, an amount that will be foregone if the company makes them instead. Compare the purchase price of $89 to the relevant manufacturing cost of $82.90, and buying the cases will cost $6.10 extra. This means Covalite should make the cases in-house. Turn over to page 11 to look at exercise 5. A company is considering replacing an old piece of machinery which costs $168,000 and has $88,000 of accumulated depreciation with a new machine that has a purchase price of $107,900. The old machine could be sold for $90,100. The annual variable production costs associated with the old machine are estimated to be $11,200 per year for 8 years. The annual variable production costs for the new machine are estimated to be $8,000 per year for 8 years. Prepare a differential analysis to determine whether to continue with the old machine, alternative 1, or replace it, alternative 2. First, we examine the cost of the current machine along with its accumulated depreciation. These costs have already been incurred, so nothing we could do going forward can change them. In other words, these costs are sunk costs, so we ignore them in our analysis. A cost that is not sunk is the purchase price of the new machine. This cost will not be incurred if we keep the current machine, but it will if we replace it. So the differential effect is an additional cost of $107,900. Likewise, the sales price is another amount that differs between these two options. If we keep the current machine, it is $0. But if we replace it, we bring in $90,100 in other revenue. Then, of course, there are the production costs. Keeping the machine would entail 8 years of production costs at $11,200 per year, or $89,600. Replacing it would lower these costs to $8,000 a year for that same time period, or $64,000, meaning the replacement would provide $25,600 in cost savings. The total net cost for these two options are $89,600 for keeping the old machine versus $81,800 for replacing it. So opting to replace it would be $7,900 less expensive than keeping the old machine. In the bottom half of the same page, you'll find exercise 6. Timberjack Lumber Company incurs a cost of $398 per 100 board feet in processing certain rough-cut lumber, which it sells for $532 per 100 board feet. An alternative is to produce a finished cut at a total processing cost of $515 per 100 board feet, which can be sold for $656 per 100 board feet. Prepare a differential analysis on whether to sell rough cut, alternative 1, or process it further into finished cut, alternative 2. Initially, we can observe the revenues and costs per 100 board feet of rough cut lumber, which yields $532 of sales revenue and $398 of costs. Processing the rough cut lumber into finished cut allows the lumber to be sold for $656 per 100 board feet, with a total cost of $515 per 100 board feet. The differential revenue for processing the finished cut is therefore $124, while the additional costs are $117. In other words, the profit from selling rough-cut lumber would be $134 per 100 board feet and $141 per 100 board feet of finished cut. So processing further yields an additional $7 per 100 board feet sold, making that the better option. You have now seen every type of problem involving differential effects from this chapter. There are a few more you can try on your own. You'll find the solutions file available in Blackboard. All that said, allow me to cover one more problem. Roadrunner Tire and Rubber Company has the capacity to produce 170,000 tires. Roadrunner presently produces and sells 130,000 tires for the North American market at a price of $175 per tire. Roadrunner is evaluating a special order from a European automobile company, which is offering to buy 20,000 tires for $116 per tire. Roadrunner's accounting system indicates that the total cost per tire is as follows. Direct materials, $56, direct labor, $22, factory overhead, $25, and selling and administrative expenses, $26, all for a total cost per unit of $129. Roadrunner pays a selling commission equal to 5% of the selling price on North American orders, which is included in the variable portion of the selling and administrative expenses. However, this special order would not have a sales commission. If the order was accepted, the tires would be shipped overseas for an additional shipping cost of $7.50 per tire. In addition, the European company has made the order conditional on receiving European safety certification. Roadrunner estimates that this certification would cost $165,000. Prepare a differential analysis on whether to reject Alternative 1 or accept Alternative 2 this order. I know this problem looks like a lot, but it's much simpler than you might expect. You just need to organize the information appropriately. If you're feeling inspired, I would recommend pausing the video and trying this problem on your own. You could start by identifying the costs of this order. Note that fixed costs will not be impacted by this order, so we need to identify the variable portions of overhead and selling and administrative expenses. The variable portion of overhead is given at 60%, so that amount works out to $15. Selling and administrative expenses are 45% of $26, or $11.70. Additionally, included in that variable portion of S&A expenses is a commission equal to 5% of the original sales price. This order would not have this commission, so we need to reduce that $11.70 by $175 times 5%, or $8.75. The actual amount of selling and administrative expenses associated with this order will be $2.95. So our updated amounts for overhead and S&A expenses are $15 and $2.95. This order also has an additional shipping cost of $7.50 per unit. The final cost associated with this order is the cost of acquiring a European safety certification, which would be $165,000. Now we encounter a challenge. The certification is in total, but all the other costs are on a per tire basis, so we need to do a conversion. We can convert those per unit costs to a total cost for this order by multiplying them by the total sales units for this order. This order is for 20,000 tires. So multiply direct materials, direct labor, variable overhead, variable S&A expenses, and shipping costs each by 20,000. The resulting products are their aggregate amounts. Those 20,000 tires are being sold for $116 a piece. That information gives us our revenues, or $2,320,000 for this order. If we reject this order, we earn no additional revenues and incur no additional costs. The profit associated with accepting this order sums to $86,000, compared to nothing from rejecting it. So this order should be accepted. Turn to pages 14 and 15 to try something new. This problem covers production bottlenecks, how to manufacture considering sales and production limitations. Sun Company produces two products, R and T, with the same machine. The following information is available. In this table, you see the sales price per unit for product R and product T, as well as their associated variable cost per unit, contribution margin per unit, machine hours for producing 1 unit, and maximum unit sales per month. The company presently operates the machine for a single 8-hour shift for 22 working days each month. Management is thinking about operating the machine for 2 shifts, which will increase its productivity by another 8 hours per day for 22 days per month. This change would require $12,250 additional fixed cost per month. Part 1. Determine how much of each product should be produced if the company only operates the machine for 1 shift each day. The first thing we need to identify is the contribution margin per constraint for each unit. This ratio shows which product is the most efficient use of our time for generating revenue. To figure this number, divide each product's unit contribution margin by its respective machine hours to produce a single unit. From this information, we see that manufacturing product R is the best use of Sun Company's efforts. So how many units of product R can it produce in this month? Currently, Sun Company runs its machine for 1 8-hour shift for 22 days each month. Multiply the 22 days a month by the single 8-hour shift each month, and the total available manufacturing hours are 176. Again, this is the maximum possible number of manufacturing hours available each month. The next question is, how many hours do we need to make 550 units of R, the most of that product we can sell? Take 550 units and multiply them by 0.4 hours per unit to get 220 hours per month. If it takes 220 machine hours each month to maximize units of product R, but we only have 176 machine hours available, we cannot produce 550 units. Instead, we are limited by how many units we can make with these 176 hours. To figure that quantity, multiply those 176 hours by 1 unit over 0.4 hours. The result is 440 units of R for the month. This is the largest quantity of product R that we can produce with 176 hours. Now we can move on to part 2. How much of each product should we produce if Sun Company operates the machine for 2 shifts instead of 1? Now, instead of 8 hours of machine time every workday, we have 16 hours. Consequently, the maximum hours for manufacturing doubles to 352 hours per month. If we only need 220 hours to manufacture the 550 units of product R, we can maximize the sale of those units and use the remaining hours for product T. And now the question becomes, how many units of product T can we make after making 500 units of product R? If we have 352 total hours available, and we subtract the hours for making product R, we have 132 hours left for making product T. Multiply those remaining hours by the time required to manufacture 1 unit of product T, in this case, 1 hour. And Sun Company can make 132 units of product T during the month. This number is less than the maximum sales volume possible for product T, so 132 units of T is the quantity we will produce. If the maximum allowable sales volume was less than 132, that would limit how much we would make of this product during the month. So for part 2, Sun Company will manufacture 550 units of product R and 132 units of product T each month. Turn to page 16 to see how product costing methods are applied. The following costs were incurred to make 10,000 units of a product. I'd like to make the math a little easier to follow, so let's change this 10,000 units to 100,000 units. In the following table, you'll see your per unit variable costs as well as your total fixed costs. This company desires a 30% return on its assets of $1 million and expects to sell all 100,000 units. Determine the unit sales price using the variable cost method, the product cost method, and the total cost method. Whichever method we employ, we will always use the following 3 steps. Step 1, determine the per unit cost. Step 2, determine the effective markup percentage. Step 3, increase the per unit cost in step 1 by the markup percentage found in step 2. Since we are starting with variable costs, we will find the per unit variable cost in step 1 and increase that cost by the markup in step 3. Our variable costs are already provided to us on a per unit basis, $5 per unit for manufacturing costs and $2 per unit for S&A expenses. Combine these two together and the variable cost per unit is $7. Figuring the markup percentage takes several steps. First, we need to figure out what the desired profit is. How much income we wish to make will impact how much markup we apply to our product. In this case, we want a 30% return on our $1 million of assets. So we want to earn $300,000. To get the markup percentage, we take that return and add it to our fixed costs. That is, the costs that aren't the focus of the method in question. Then divide that sum by the total variable costs, the costs that are the focus of this method. Fixed costs for both factory and S&A expenses are already given in their aggregate amounts, so combine them to get $130,000. Add that amount to the desired return of $300,000 to get $430,000. Now we need our total variable costs. The per unit variable costs are $7 per unit. Total units to be produced are 100,000 after our edit. So total variable costs will be $700,000. Divide that into $430,000 to get a markup of 61%. Finally, we can figure out what the sales price should be by increasing the per unit variable cost by the markup percentage. Note that you would multiply $7 by 1.61. Multiplying it by 0.61 would give by how much we should add to $7, the markup itself. Using 1 plus 0.61 gives the sales price after adding the markup. Next, we'll do the product cost method. This method will follow the same steps as the variable cost method with minor alterations. In step 1, we'll determine the product cost per unit, and in step 3, we will increase that cost by the markup percentage. So first, we'll determine the product cost per unit. Variable manufacturing costs are $5 per unit, but fixed overhead is given as an aggregate amount. No problem. We can convert that aggregate amount to a per unit amount by dividing it by 100,000 units. The per unit factory overhead comes to 90 cents per unit. We'll then combine these two costs to get the total per unit production cost. $5.90. The desired return will not change at all. However, instead of summing that desired profit by total variable costs, we'll do so by total selling and admin costs. Remember, whatever cost is in the method's name, we use that non-named cost in step 2. Since this is the product cost method, we use the non-product costs, or the S&A expenses, at this step. The total variable S&A expenses are $2 per unit, and the fixed S&A expenses are $40,000. We can turn that $2 per unit into a total amount by multiplying it by 100,000 units. Combine that $200,000 with the $40,000 fixed S&A expenses, and total S&A costs are $240,000. We divide that number by the total costs of the method's name. In this case, total product costs. We figured out the per unit production cost in step 1, so just multiply that $5.90 by 100,000 units to get $590,000. The markup will therefore be 92%. As for step 3, we apply that markup to the per unit cost from step 1. Multiply $5.90 per unit by 1.92 to get a sales price of $11.30 per unit. Finally, we'll finish up with the total cost method. The name of the method gives us the type of per unit cost we're looking for in step 1, total cost per unit. That's the cost we will apply the markup to in step 3. To get total cost per unit, we need to express all of our costs on a per unit basis. That's easy enough for our variable manufacturing and period costs. For their fixed cost counterparts, we'll need to divide both those numbers by 100,000 units. Per unit fixed factory overhead will be 90 cents, and per unit S&A expenses will be 40 cents. Now we simply sum our 4 per unit costs to get the total per unit cost. $8.30 per unit. Since we know we're going to need the aggregate total cost for step 2, let's proceed with multiplying that amount by 100,000 units to get $830,000. The desired return of $300,000 is still unchanged. In the previous 2 methods, step 2 adds to that return the costs not used in step 1. For example, the variable cost method found the variable cost per unit in step 1, then combined fixed cost with the return in step 2. Since this method used total cost in step 1, we don't have any cost to add to the return in step 2. Instead, just divide the return by total cost to get the markup percentage. 36.14%. For step 3, we'll take the total cost per unit found in step 1, then increase it by the markup in step 2. Again, add 100% to the markup percentage, then multiply the resulting sum by the total cost per unit to get the required sales price. $11.30 per unit. Hopefully, you noticed that regardless of the method used, we were able to determine the same unit sales price of $11.30. So the good news is, if you need corroboration over whether your answer is correct, you can always use one of the other methods to verify your result. That concludes this video. There may be a couple of problems in the workbook I didn't cover. If so, you can find their solutions in the course module in Blackboard. I encourage you to try them on your own to test your retention of the material. Please let me know if you have any questions. Thank you for watching.